Welcome to the show. I'm Andy Hagans, and today we're talking more about the big thesis in oil and gas. Why is Warren Buffett investing so much in this sector? Joining me today is Ben Fraser, Managing Director at Aspen Funds. Ben, welcome to the show.
Yeah, thanks for having me, Andy. Looking forward to our chat here.
And Ben, I got to give you some personal credit to turning me onto this sector, like legitimately, you personally. But right off the bat, we're name dropping Warren Buffett, right? And that does get people's attention, and you could call it clickbait or whatever, but it's true, right? When he invests in a sector, whether it's railroads, whether it's insurance, whatever it is, people pay attention. It's not only why is he investing in oil and gas, but why now, right?
Um,
How excited are you about this sector on a scale of 1 to 10? Oil and gas 2023. How excited is Ben Fraser?
yeah, well, I'm way more excited. Once I saw that Warren's making some pretty big bets in oil, because we, kind of put our thesis together before I saw him making moves. So, I mean, Warren's probably just following me and trying to just copy what I'm doing. Is the real answer? No, but yeah, no, it was definitely confirmation of what we've been researching and studying for the past couple of years and making some investments into the space. And as we've done it and learned a lot more and seen what's going on in the bigger picture, it's just when you kind of lay it all out, it's pretty hard to argue that it's not good to have at least some exposure to this asset class.
Yeah, absolutely. And one thing I like about Aspen Funds, I've told you this before, Ben, but you all have this macro focus, and I think that kind of flexibility, it gives you freedom. I don't want to say to chase higher returns, but it's like in the alternative investment landscape. And I talk to all kinds of different sponsors on my other podcast, the Alternative Investment Podcast. There are sponsors that focus on one sector, and I think on the plus side, you can develop deep expertise that way. So I'm not throwing shade on that idea. But on the negative side, is it like if you're saying, I'm just going to invest in this one thing, it's almost like you're saying, I'm going to invest in this one thing regardless of price, right? Whereas when I speak with you and when I speak with Aspen Funds, I get the idea more that, you're looking at this big picture. You're saying, the opportunity in 2018 is different than the opportunity in 2020 is different than the opportunity in 2023. Is that a fair reflection of your all philosophy?
Yeah, no, you described it really, really well. It kind of goes back to how we started originally, which was more opportunistic and finding an opportunity in a niche in a sector and building that out and being able to capture outsized returns because of the timing. And so we've kind of gone against maybe a traditional model of vertically integrated in a single asset class, single sector, and there are advantages to doing that. So I agree with you. There's can be good reason to do it. But what we like to do is we'd rather partner with those people and be able to have an agile business model and put together, really good, macro thesis for any deal that we do, but then really good investor structures and teams around the deals that we put together. But then we're not beholden to that particular asset class to work forever because, as you know, as every investor intuitively knows, asset performance or asset class performance goes in cycles, and there's better times to invest in certain asset classes than others, and we all understand that, right? But it's difficult to do that on the operator side of it, and so that's been our model. And part of the reason that's our model is we invest in every deal that we do, and so we're kind of more of a family office approach to looking at the landscape of opportunities and trying to identify where we think the best opportunities are, and then we go and put our own capital in there and alongside of our investors. And so we'd rather not have too much concentration in just one asset class, one vertical. And, most investors are the same.
Yeah, and I love that reference to family offices because I think the very best family offices, they are patient, and even over the past couple of years, I observed some of them um, waiting, which is sometimes it's the hardest thing to do is to wait, is to sit on cash. But if you're looking at whether it's commercial real estate or the stock market or whatever, and if you see something you think is significantly overpriced, sometimes that's the best thing you can do. But I want to shift now to conventional energy, why Warren Buffett is investing, why you're investing, why I'm investing in it. And I want to start on the demand side. I want to start on the demand and then get to the supply. Um, because the big thesis that I talked about on the first episode of this show, that the world is moving to renewable energy, and that's true, right? It is true that we're moving to renewable energy in the United States and globally. But there still is tremendous demand for oil and gas, and there will be really for the foreseeable future. Do you think this is a point that a lot of investors, that a lot of folks are missing, that they're kind of missing, just not understanding the demand for conventional energy?
Yeah, I mean, it's such an interesting thing because I think people, you know, who doesn't want renewable unlimited energy at, very low cost, right? That's the dream, and that's a great goal that we should strive towards. But the reality is we've had renewable energy sources for many, many, many decades, and
Mm-hmm.
they've simply not become cost effective, and simply they have some pretty significant drawbacks. One of the biggest ones being intermittency in, like, for wind and solar,
Right.
and be able to store the energy for when you actually need it. And so, there's been some pretty big things that we have not been able to solve yet. And, you know, as the world's become more environmentally, focused, it's shifted a lot of attention towards, these types of energy sources. And that's a good thing. We should provide incentives, for those. But if you kind of take a step back and look at, okay, what is needed to make this transition and how long will it take to make that transition? I think most people, again, intuitively think like, hey, we're probably being a little bit optimistic here, right? Because we've been doing this for a while and it hasn't really got us to where we want to. And sure, there's some political, bravado behind it. But I think if people actually looked at the numbers and the data at what it would take to get to where they want us to go, it's just, it doesn't make any sense. The numbers are untenable. It's so far beyond reality at this stage that
Mm-hmm.
it's mind-boggling if you look at the numbers. And so you take a step back and think, okay, that's unrealistic. Meanwhile, there's been, I don't want to go to supply yet, but there's been a huge gap in the reinvestment of new fossil fuels, and that's creating a whole nother set of issues. And so, I really think we're at the beginning stages of a potential energy crisis over the next decade or two. But on the demand side, we have, we've been doing a lot of things, and right now, the latest data that I've seen from 2020 is, only 17% of the energy that we use in the world comes from non-carbon sources. So 83% of the world's energy demand is still met by fossil fuels. And if you look at a lot of the projected, where are we going to be in 2030 and beyond, the IEA, the IEF, a lot of these big agencies that are trying to aggregate data and project where it goes are predicting that there's a lot of different variances or ranges to where it's going to be, but it's likely that 10 years from now we still have the same, if not more, demand for fossil fuels than we do right now. And so
Wow.
even 10 years from now, it's still the same deal. And
Now,
because
Ben, if I could stop you there, is that because I know that global population growth is still growing, but it's slowing down. So is that population growth driven, or is it more like, folks in the developing world, as those economies develop, they then have more of a demand for conventional energy in these developing economies? Like, what is that? What is in that fact? What's behind that fact that there's more demand for conventional energy in 10 years?
Yeah, I mean, I think there's probably some population growth in that assumption, but the reality is most developed countries are having negative population growth. So
Right.
the short term, that's probably a little bit of a factor as we kind of like hit peak population in certain countries, but it's definitely not the biggest contributor. I think the biggest contributor is understanding the limitations we have for rare earth minerals and other things that we need to mine more of to create more of these renewable sources. So, one of the other kind of interesting stats from the IEA, this is the big agency talking about this, right? Just to meet the Paris Agreement goals, which are kind of the standard goals for meeting certain benchmarks of transition to renewable energy sources, we would have to have a 40x increase in lithium and 20x increase in nickel and cobalt over the next really 20 years. And if you look at where are most of these minerals being sourced from, it's mostly from Africa in very, very, very poor working conditions, like almost concentration camp level working conditions. And it's a very, very, very dirty business. So it's kind of ironic that the environmentalists are so big proponents of this. Meanwhile, the way that we're getting these minerals is extremely dirty, extremely against human ethics standards. But even aside from that, there's no new mines being permitted. In the U.S., we haven't permitted a new mine for I think it's many, many decades, and we have an abundance of resources here in the U.S., but we're not mining for them. And so it's not just incremental, right? These are 20x and 40x increases in production just to hit some of these benchmarks that are pretty far out already anyway, of the transition time periods. And so even if you believed all of the benchmarks that we could hit to the transition of renewable energies, it's still a long ways out before it even is a predominant source of our energy. But then if you look at the other side of it, on the supply side, it's on fossil fuels, we're set for a pretty big turbulence in the short term.
Yeah, and Ben, I want to talk about supply here in a second, but one other point I want to make about demand, I think it's good you bring up the environmental aspects of this. Also to bring up the fact that the increased demand in many ways is a good thing, right? Because it signifies that worldwide many global citizens are being lifted out of poverty, right? And so as citizens in developing countries are lifted out of poverty, they have, economically speaking, an increased demand for energy, right? So it's really simply reflective of countries like India or countries in the Southern Hemisphere, South America, Africa, all over the globe, Southeast Asia. That increased energy demand is really reflective of the fact that we have a decreased poverty rate across the globe, and more folks in globally that are being lifted out of poverty. So it's I understand that it can get complicated. You can talk about the environmental aspects of it, but it's not a bad thing that there's an increased appetite for energy. It represents clothing and food and education and transportation, where in a lot of places had very limited infrastructure in the past.
Absolutely. And I'm really glad you brought that up, because it's a whole other side conversation we could have. There's a great book that I read recently called Fossil Future by Alex Epstein. And he's a little bit of a political polarizing figure. So, I don't agree with everything that he said. And I don't generally like to get super political on this topic, because it can really, people have very strong opinions, right, about climate change and environmental issues. And, those are things that we should be addressing. But he makes a really, really good point that you were alluding to, in that the access to energy, and not just energy, but cheap energy, has been the single biggest contributor in the global human flourishing in the history of humanity. I mean, there's not been one single contributing factor that has allowed the progress of humanity more than cheap energy and cheap access to energy. And if you look at it just from a simple apples to apples comparison, oil is the most energy dense and easily transportable fuel source that we've ever discovered. And so it's very, very difficult to replace it, right? Because it is so energy dense and it's so easy to transport. And so, if you look at it from just a pure ethical framework of, is our goal to lift human flourishing across the globe? Are we trying to allow, more access to, first world developing, infrastructure, roads, transportation, other things? Well, we need energy to do that. Do we want to reduce poverty? Do we want to reduce, starvation, reduce all these other things that are generally pretty goals that most people would agree on? Energy is needed for all those things. And so it kind of goes to a bigger issue that if we are not focusing on the current needs right now, while we're trying to make the transition, we're actually going to potentially cause a lot more issues, not just from we have high oil prices, but actually some of these developing countries are put in a very difficult position.
100%, 100%. So, the demand is, it's not just, I think folks sometimes think of, well, Americans need a third and fourth SUV or whatever. That's what's driving it. It's like, no, we're talking about globally. A lot of people are getting their first motorized vehicle or first car, first motorized bike, that sort of thing. And so regardless of what we do in the United States with our energy policy, that demand is going to be increasing globally, period. Right.
Right.
And that is what it is. So let's talk about supply. Right. So we're talking about demand, and that plays out over time. One would think, with the efficient markets theory, that when there's demand for any kind of commodity, that capital, that investors say, well, we will invest in supply in this commodity as long as we are achieving some sort of reasonable or desirable risk adjusted return. Is that happening? Is there enough supply being supplied now, and what about in the near future?
Yeah, absolutely. Great question. And one of the unique things about the supply of oil and gas is it's a pretty significant lagging indicator, right? So the supply we have now is a result of efforts that were started many, many years ago, from exploratory drilling, new permitting, doing drilling, completing wells, building infrastructure, transporting it through the midstream companies, getting it refined, and then to the consumer. And so there's all this like big stage, or many stages of the process to get from initially thinking about drilling oil to actually getting to consumers. And so it's really a lagging indicator. You have to forecast what are the activities that we're doing now, and what does that predict in the future. And so if you look at just the current investment landscape for new drilling activities, we've seen a drop of close to 50%, actually in excess of 50% over the past 7 years in new drilling for new wells and new production. And if you think about it, right, oil and gas is different than maybe other asset classes like real estate that generally appreciate over time. Oil and gas is a depleting resource, right? There's a finite amount of the resource in the basins that the wells are extracting it from. And, every time you pump some out, there's less there left. Right. And so to keep the same supply, year over year, you actually have to drill about 5 to 7% more new production or new wells every year. So we lose about 5 to 7% just by use of the wells. And
that's just for static production. That's not even assuming any growth. Okay.
Yep. So not only are we depleting that, but we have a massive drop off in the funding of new supply. And a lot of this is being driven because of the ESG narrative and the political narrative, where, for the past several years, this is even happening, many years ago, where a lot of the big politicians are telling banks, hey, don't fund new fossil fuel production. Don't, give lines of credit to these big companies. And so there's been a big shift of, the big capital allocators, the BlackRocks of the world, to where they have now these ESG scores that they have to meet, right? They have to be hitting certain environmental, societal, governance standards within their funds and their allocation, of their portfolios. And fossil fuels generally isn't, in those categories. And so there's been a huge drop in the amount of private equity funding in this space. And so, supply right now is, we're kind of teetering on, efficient markets. But if you kind of forecast out over the next couple of years, we have a pretty steep decline curve of supply of fossil fuels.
So, Ben, you're talking about I guess, according to, again, efficient market theory, an under allocation of capital to this sector by institutional investors because they have their own internal goals that are driven by ESG or driven by whatever internal policy they have. And I think it's certainly, it's in the news all the time. It's in the financial media all the time. It's not like it's 100% across the board, I guess, across every institutional investor, right? I'm sure sovereign wealth funds in the Middle East, are still happy to invest in conventional energy. But in your opinion, is it prevalent enough that it's not just, some institutional investors not to play. Is it happening at a big enough scale that it's moving the market, that it's causing mispricing?
Absolutely. I mean, just it's dropped by 50%, right, over the past 7 years. That's a massive drop. And these are 50% from kind of pretty standard levels. If you look back, over the past 10 to 15 years, the investment levels have been pretty steady. And all of a sudden it's just tailed off massively. So because of that, there's not as much competition looking to buy the same deals. And what also is kind of, I think, caused a little bit of a reset in the market is in 2020, oil prices went negative for a day. It's a lot of people don't realize that. It doesn't make any sense, right? So you actually had to pay someone to take your oil for that one day. And there's a lot of volatility in the market. And a lot of these companies were over leveraged. A lot of these funds were over leveraged. And because of that, a lot of them got burned. And so I think there's kind of also been this kind of hesitation to jump back in because, I still have some recent scars from the past. But what it's also kind of done, is it's caused a lot more kind of forced discipline into the market, right? So a lot of these big operators and producers, they like the kind of where the oil prices are at right now, right? They're making a lot of money, and they kind of see where the picture is going, and they're going to be the beneficiaries of it. And no one's, mad at them for not producing more, at least not right now. And so it's kind of caused a lot of discipline, just where a lot of them have been deleveraging. So debt's been paid down massively. There's not as much debt, outlaid to the asset classes there used to be. And there's also just a more cognizant appreciation of what is the kind of current supply and how do we, not oversupply the market based on what, the Middle East is doing and other kind of big factors. And so it's since then it's kind of kept prices in this kind of more stasis mode in the, 60, 70, $80 range. And so because of that, it's been attractive, but it's also, the big private equity is like, hey, we've got burned recently. We don't want to do that again. And meanwhile, we have to hit all these other standards for our ESG score. And, that's just kind of where the state of the market is.
When you say, Ben, when you say big private equity, you're talking about alternative asset managers like the BlackRocks. Are you talking, have pension funds or endowments, have those kind of investors historically, invested in oil and gas? Are they disappearing as well? I mean, I guess what I'm asking is what's creating the void? Were they supplying this capital 20 years ago, and then they're just simply not even looking at these deals anymore?
Yeah, that was a lot of it, right? And so a lot of it's been private equity funded. A lot of it's been bigger institutional money. So the bigger institutional money has largely dropped out. I mean, there's still some allocators that are playing that space, but like the really big allocators, like the BlackRocks of the world, they're constrained, purely because of some of these scores that they have to hit, right? And these kind of mandates that are being put on the really big allocators, of our world. And so they're not necessarily all private equity. The BlackRocks, they have a lot of public equities, but even still, that's been a big shift. Where a lot of these pension funds and endowments and other bigger institutional investors that are shifting the allocation. Yeah,
and that's always interesting to me, and that really, to me, that's almost the hinge. The hinge for me, it's the hinge of this entire thesis, is the mispricing that's occurring because of decisions being made here where it's OPM, it's other people's money. And, I don't have, as an asset manager, my incentive is to make sure my ESG score is good, is to make sure that, I'm invited to the next climate conference, right? My incentive is not necessarily to maximize my risk adjusted returns. As a private investor, I'm not being invited to the next climate conference and my portfolio doesn't get an ESG score.
Right.
And I'm okay with that. Like, I'm okay. Like, it doesn't mean, I don't want to imply that I don't care about, my impact on the world as an investor. But back to our earlier point, I can invest in oil and gas and sleep like a baby every night. Like, I have no moral compunctions whatsoever.
And that's what's so weird about it is it's like this mutually exclusive decision binary of I believe in environmental science and climate change or I don't. And if I invest in oil and gas, I automatically don't, right? There's a lot of gray, there's a lot of middle ground, there's a lot of, the things that are still TBD. Like we don't know exactly how this is impacting climate change. Has it impacted it? Probably, but probably not to the degree that a lot of people think it has, right? And then if you zoom out and look at, global human flourishing, it's pretty hard to argue that cheap access to energy has not been a massive driver of that. And so I feel great about it, right? I mean, I have the opposite of a moral issue with it, and I think it's something that people need to hear about, right? The other side of it, because it is very one-sided in the narrative.
So Ben, we've kind of gone to this thesis, supply demand mismatch that's caused mispricing of assets in the market. There's a lane open for private capital. I think there's a lot of investors, a lot of high net worth accrediteds, a lot of family offices that are kind of sitting in my seat, which is I'm an LP. I invest in all alternative investments. I invest maybe in commercial real estate. I'm an LP in different funds, but I'm not an energy expert. But I know enough to know that I agree with the thesis. I want to invest some money. So let's talk about what are the opportunities in the market right now. As a starting point, just like with multifamily, with commercial real estate, not every deal is the same, right?
Yeah, absolutely. And I'd probably say even more so in oil and gas than other asset classes. And, I think there's bad actors and bad operators in a lot of different asset classes. But, for some reason, the oil and gas space just tends to attract some eccentric people into it. And
It was
so
the original crypto, right, Ben?
right.
To 150 years ago or something.
Right. I mean, to be honest, this wasn't directly an oil and gas like drilling fund, but you may have heard the rumblings of this, but kind of through the private equity space and several groups that I'm kind of familiar with, there was a big Ponzi scheme that just got taken down by the SEC. They raised $250 million for a carbon capture thing, and it was 100% hoax, right? It's not directly in oil and gas, but it kind of touches the fringes of it. And
Right.
it's, people just, they're hesitant. Right. And so we kind of tiptoed into this space a couple of years ago because of that. Right. Our approach was, one of our partners said his, all he heard from oil and gas was, it's a hole in the ground with a liar on top is kind of the, standard operating procedure of most oil and gas, people in the space.
Yep.
You kind of have to go into that approach a little bit because there's a lack of knowledge. A lot of times you're playing at a disadvantage of what they're selling, right? And you can make a spreadsheet say anything you want. And I think I was telling you offline before, we were at a conference a few weeks ago where there are some sponsors and they're selling different investments into new drilling programs that they're doing. These are vertical wells. And they're selling them for like $3 to $4 million a well. And I know firsthand, because I've drilled a lot of wells, that it costs about a quarter to a fifth of what they're selling for. So they're marketing it up 3 to 4x day one to investors. And then you have all the risk of that one well not hitting oil, or at least not economically hitting oil. And so you're left with, a bad deal. And so it's been interesting as we've been in the space more. You kind of have generally two very polarized opinions when you have talked with people that have been investing in the space of either has been really, really, really good and they, got lucky, or has been really, really bad and they lost money. And so I say all that to say is not all two things are created equal. And there's a lot of, there's just a lot of people out there that maybe even aren't bad actors, but they're just new. They're, selling a line and the incentives aren't aligned. So it's very, very important as a passive investor to make sure you understand who you're investing with, what the strategy is, and what the incentives and alignment of interest are in every deal. This is the same stuff you do in every deal, but even more so here.
Yeah, and Ben, that reminds me, I know a lot of our audience is invested in commercial real estate, and as an LP, you come in, you look at a deal, you want to look at incentives, right? You want to look at the terms, you want to do due diligence. You want to look on at the track record. Is there anything, I guess, different from, compared to real estate deals, or, is there anything unique about oil and gas that maybe a newer LP should educate themselves on?
Yeah, I mean, just a lot of the vernacular is different. A lot of the way that the deals are structured is different, right? So they're generally limited partnerships versus limited liability companies, which changes the tax implications. Fees are a lot of times different than what you're used to in real estate. And then I think that the biggest difference is what type of investment are you investing in, right? Because in my mind, there's kind of a spectrum of types of deals you can invest in, and what I see most of the time being marketed are a package of new wells being drilled. So say a company that's saying, hey, we're partnering with these operators to go drill 3 new wells. Here's what we're selling this for, the interest in this wells for, and they're always leading with the tax advantages, which are great in oil and gas. So don't get me wrong. I love the tax advantages, which we could talk about if you want, but people get so enamored by that they kind of forget to look at the actual investment thesis, make sure it's a good investment, right? So, we've said before, you don't want to let the tax tail wag the dog. And what happens is you can pre-fund a lot of these drilling expenses in the calendar year that you make the investment, and then you can take a big loss, tax loss that year, and then you can drill the wells. And so why does that matter? Well, if you're only investing in a couple wells, you have a lot of idiosyncratic risk with those wells being economical. And so what if one of them doesn't hit oil, or what if a couple of them don't hit oil, right? All of a sudden your variance of return is extremely high, because it can be really, really good, but it can also be a zero. And so when you're investing in a smaller number of wells, variance of return goes up, which is one of the key measures of risk, right? Is variance of return. And so on a risk-adjusted basis, those aren't, in my opinion, a great way to deploy capital. And so what we're focusing on maybe the lower end of the risk spectrum is buying existing producing packages of wells that have acreage, that have working interest rights to be able to do more drilling on, and generally more infill drilling. So it's not exploratory. It's just there's already been 1,000 wells drilled. We're going to drill the 1,000th of the first well. And you have usually lower risk, higher success rate than doing pure wildcat or exploratory drilling. But you get the benefit of the existing wells producing cash flow, plus you get some of the upside on the drilling, but it's a little bit less variant, reliant on those wells, the new drilling to perform well for the investment to perform well.
And Ben, I think that is a really interesting strategy. I mean, to use a rough analogy, I'm sure it's not perfect, but going out and doing exploratory drilling, that's more like venture capital, right? It's when you might hit it big, have really high returns, but you're going to have more strikeouts. You can probably build that into your investment model if you diversify over, and if also similar to venture capital, do you know the right people? Are you experienced enough to be able to, spot the right managers and all that? So a lot of potential there, but a lot of risk, right? And it's kind of built into that model versus what you're talking about, a little more oriented towards cash flow. And what I really like about it, you talked about how it's that infield drilling, buying existing assets. It's maybe a little bit lower on the risk return profile, right? So you might be giving up theoretically a little bit of return, but then that goes back to the first part of our conversation, which is just the underlying economics here are really, really good. So as an LP, I don't feel the need to necessarily be, quote unquote greedy. Like I go into it with the mindset like, oh, I have to 7x my money or whatever.
I think it's a great point and a great mindset, because I was going to say, just before you said that, is that in the current market, you don't have to go and take these crazy risks to get a pretty decent return. Like right now, like we have a deal under contract. We're going to be closing on here very soon. We're buying the existing production with all the engineering, all the kind of decline curves built into the depletion of the resources, built in with time value of money, discounted cash flow models, right? This is basic finance math. We're buying it at a 20% cap rate. So a 20% cash on cash return at, you know, the futures price of oil, which, you know, doesn't really bake into a much upside into the price of oil. And
Right.
so at current prices, we're generating a 20% annualized return unlevered. That's a pretty good rate of return, right? And so to me, it's always comes back to risk adjusted return, right? And so where can I get a decent return without taking an inordinate amount of risk? And I think you don't have to take a lot of risk right now to get pretty good returns in this space.
Yep. And that's the lane for private capital, right? It's interesting. Seems like one of the few sectors, few areas of the investment landscape where maybe the smaller private investor is almost at an advantage. At least, you know, when I compare myself to a BlackRock or some huge asset manager, it's always getting beat up on the front page of the Wall Street Journal. And it's like, you know what? If they wanted to maximize their returns, they probably would invest in this, but because of reasons we already discussed, they can't. But you, the individual high net worth investor, or you, the family office, you can. There's nothing stopping you, right?
Totally, totally. I mean, they are at a disadvantage just purely based on size, right? There's just certain things they can't do unless they can write $100 million check, right? And a lot of times the best opportunities are kind of in that small middle market area, and especially in oil and gas, right? You know, we're kind of avoiding a lot of the mom and pop, you know, deals and operators. We're kind of going more into the middle market, because, you know, less competition there because you have to be a bigger check writer, but the bigger check writers that usually write those checks aren't there. So that's why we can get these really good values for existing production, and you know, capture a really unique time in the market.
Ben, can't thank you enough for all of your insights today. For our listeners of high net worth investors, family offices who'd like to learn more about your offerings, Aspen Funds operating in oil and gas, where can they go to learn more?
Yeah, you can check out our website at Aspen Funds, ASPENFUNDS.us. And on the front page there, you can see our list of current offerings. And not sure when this will be published, but it's likely we have some room left in our energy fund for this year. And you can definitely check out what we've got going on in there if that's of interest.
Awesome. And we'll be sure to include that in our show notes, which are always available at wealthchannel.com. We'll have all those links. We can also include the link to the Warren Buffett news story that we referenced earlier in the episode, and to Aspen Funds as well. Ben, thanks so much for joining the show today.
Yeah, thanks, Andy. It was fun.